That evening on Monday, the 14th of September 2008, felt like the atmosphere just before a storm. People sensed something ineffable, something lingering in the air of the world's great financial centres, but far from everyone understood the scale of the tragedy already unfolding. To understand how such a catastrophe could occur, one must travel back in time to the moment when everything began to accumulate its inexorable weight. But most importantly, we must distinguish the moment when the world of finance transformed from confidence to panic, from faith in the future to fear of the unknown. The 2008 crisis did not emerge suddenly in September. It had been accumulating over many years, like hot steam in a sealed container. It all started with something that seemed innocent and natural at first. People wanted to own their own homes. This is a basic human instinct, the desire to have a roof over one's head, a space for one's family. But what began as fulfilling this natural desire transformed into something far more insatiable and destructive. American banks, already in the early 2000s, began actively issuing mortgage loans borrowing money for housing. The problem was that these loans were given to people who truly had no basis to expect they could repay the money. Such loans were called subprime mortgages because they were issued at higher interest rates to applicants whom traditional banks would have rejected. Financial institutions, however, were not inclined to simply hold these risky loans themselves. Instead, they sold them further. A bank would issue a loan, receive a commission for it, and then resell this debt to another organisation, thereby transferring the risk to others. Here begins the most interesting and most tragic part of the story. From these collections of mortgage loans, directly including many risky and questionable credits, financial companies began creating complex securities. They packaged them into divergent structures that sounded powerful and scientific collateralized debt obligations, or CDO. In reality, these were just collections of debts, mostly consisting of loans from people who would never be able to repay them. Rating agencies, the very organizations the world trusted, gave these securities the highest ratings, marking them as AAA, the most reliable. How this happened remains one of the greatest mysteries of this crisis. One could say that these agencies were dirty players in the game, that they were paid by the banks issuing these very securities, so they were not interested in objective assessment. The result was that these securities spread across the world like holy bread. Large investment funds, pension savings, banks in Europe, in Asia, everywhere began buying these securities, thinking they were protected from risk by the highest rating. All this time, in the same period, the American real estate market was boiling with activity. Housing prices climbed inexorably, sometimes doubling or tripling in one period or another. People were buying homes not because they needed space, but because it seemed like a wonderful business. They would buy property intending to resell it in a year or two for a profit. Banks encouraged this, issuing loans for houses that cost 1.5 times more than what a person earned in a year. Everything seems so obvious. If prices keep rising anyway, why not take this step? Why not borrow money and play this game? When everyone around you says that tomorrow will be even better, it's hard to force yourself to doubt the future. But sooner or later, every miracle ends. And on that day in 2008, house prices began to fall. Simply, without dramatic reasons at first glance. Simply, demand began to decline because the market was oversaturated with material. People who had taken out loans at 2% interest expecting the rate to remain fixed suddenly discovered that the borrowing rate had jumped to 8, 9, sometimes 10%. Their monthly payments doubled, tripled. People who 3 years earlier were ready to swear they would always have a job with the same salary suddenly began to understand that a job is not guaranteed. The economy began to slow down. The first cracks in security began appearing in the summer of 2007, when Bear Stearns announced serious problems in its mortgage funds. But the real moment of truth and understanding that time was running out came only with the arrival of September 2008. By that time, banks all over the world already knew something was wrong. Large financial institutions began comparing these CDO securities, which earlier seemed so wonderful and reliable. With reality, people stopped paying their loans. And when people stop paying, it becomes clear that the emperor has no clothes. There was no real value in these securities. They were just an abstraction, a game with numbers, a game based on the assumption that there would always be someone else who would buy these securities cheaper than their next owner. It's like a pyramid, but with the greatest abstraction in history at its center. The collapse of Bear Stearns in early 2008 was the first serious blow. The Federal Reserve System organised an emergency purchase of the company by JP Morgan, but this was merely a small portion of what was to come. As summer turned to autumn in 2008, banks began to realise that they might not have enough money to settle with each other. This was the greatest discovery. Large financial institutions, which seemed so powerful, turned out to be dependent on each other, like climbers tied together by one rope on a cliff. If one falls, it drags all the others down with it. Lehman Brothers, one of the oldest and most prominent investment banks in America, had been standing for months on the side of hiding its real problems. The bank held a huge portfolio of dead, unusable mortgages and securities. Even the bank's leadership understood they were in trouble. They sought salvation, trying to find financial institutions that would buy them or save them. Government officials tried to prevent the catastrophe. But on the fateful day before Lehman fell, on Monday, September 14, negotiations collapsed. Large banks did not want to take on this organisation's burden. Even with the support of the Federal Reserve System, it seemed too risky. That evening, in that large office of Lehman Brothers in downtown New York, people understood it was all over. Around midnight, the bank's leadership announced that the company was filing for bankruptcy. It was almost impossible to comprehend. Another large company, AIG, a huge insurance company, began to falter. This company actually insured risks from these bad securities. It promised that if these CDO papers fell in price, AIG would pay the liability, but AIG did not have the money for such payments. In fact, the company did not expect these securities to ever fall in price. Oddly enough, everyone believed that the housing boom would be eternal. The Federal Reserve System asked Congress to allow it to save AIG. For the first time in United States history, the government intervened in private financial institutions on such a scale. The Federal Reserve System also decided to radically change its monetary policy. It began injecting about $700 billion into the market to maintain a shortage of money in circulation and distribution. This was the first bailout, and the first step toward what later became known as TARP, the Troubled Asset Relief Program. Panic spread like wildfire. On Tuesday, September 15, stocks began falling at tremendous speed. News anchors on television became unrecognizable. They reported that this was the worst in the past 2 decades. It turned out that too many organizations were dependent on these mortgage securities. Banks all over the world lost a lot of money. In Great Britain, Northern Rock Bank collapsed. In France, numerous banks began to complain and suffer. Even in distant Australia and Japan, panic erupted. But ordinary people suffered the most. People who had invested their pension savings in pension funds. People who held stocks through their portfolios in their bank accounts. Within a few weeks, people saw their portfolios lose half their value. For a person on the brink of retirement, or for someone just beginning to accumulate for that retirement, it was financially devastating. A wave of evictions began. People could not pay for their homes. Some decided simply to leave their houses to the mercy of the banks. Unemployment began to rise as companies began cutting costs, laying off hundreds of thousands of workers. What were the preconditions that led to this? First, there was a culture of risk in the banking industry. Management of large financial institutions received enormous bonuses based on short-term results. If your bonus depends on how many loans you issued this year, you will issue loans to very risky people. If your bonus depends on how many securities you sold, you will sell the most risky material. This is a distorted system of incentives. Second, there was a regulatory vacuum. The government and financial regulators simply did not understand what these new, complex financial instruments were doing. CDOs and other derivatives were so abstract and complex that no one could really calculate their true value. Regulators believed that markets regulate themselves. They believed that bankers have an internal motive not to squander their own money. This belief in market self-regulation was very, very wrong. Third, there was a positive attitude toward numbers and science. The people who developed these complex mathematical models for assessing securities were very smart. They were physicists, mathematicians, people who received millions of dollars to reveal implicit probabilities and risks. But it turned out their models were fundamentally wrong. They predicted risks based on historical data, assuming that the future would be similar to the past. But what if the past was a period when everything kept growing? What if everyone assumed the same thing? What if the models did not account for the possibility that the entire market could collapse? Risk management was simply a game with numbers without deep understanding of what those numbers really meant. Fourth, There was the matter of how the system was structured. While banks issued mortgages, they knew they would not hold these loans. They knew they would resell them. Therefore, they had no internal motivation to ensure the borrower's creditworthiness. The more loans a bank issued, the more commissions it received. The worse, the quality of loans had no significance whatsoever. This was a classic problem when the person taking the risk is not the one who benefits from the choice. Fifth, there was the globalization of finance. These American subprime mortgages were packaged into securities and sold all over the world. French banks bought them, British banks bought them, even Norwegian companies bought them. The financial system became so tightly interconnected that problems in New York instantly became problems in London, in Berlin, in Tokyo. The world had to choose, either save the system together or allow it to collapse. Everyone chose the first option, but in 2008, the process of that salvation was still unclear. And finally, there was the psychology of market participants. People in markets are driven by emotions, not just logic. When everyone around you said that the world was ending, people began to panic and withdraw their money. When people withdraw money, banks hold insufficient liquidity. When banks hold insufficient liquidity, they cannot issue new loans. When banks do not issue new loans, the economy slows down. And all of this because of a psychological panic reaction, because everyone is trying to save their own skin. The day before the crash, that Monday, the 14th of September 2008, turned out to be a division into two parts of time. Before this day, people could still be convinced that everything would be fine, that this was just a correction, that markets always recover. After this day, even the most ardent optimists began to understand that something fundamental had changed. What had been working for 30 years began to break in just a few days. The people who lost money were of various kinds. There were people who had borrowed to buy a second home for speculation. There were people who had taken out loans based on false assumptions about future prices. But there were also people, like an elderly woman, who had saved her entire life for retirement, which at that time was spread across securities and stocks. Her portfolio lost half its value. She was 64 years old. She knew she would no longer have time to recover these losses through her work. There were middle-class people who considered themselves investors. They bought stocks on credit, hoping to make a profit. Now they had debts, but no assets. In Europe, in Australia, in Canada, recession began to spread like an infection. People began to lose their jobs. Construction stopped. Companies began selling off their property to get money. Millionaires began transforming into millionaires with a minus sign. Small and medium-sized businesses closed because they could not get credit from banks. Banks themselves were struggling to sell off those securities that had actually gone bankrupt. The 2008 crisis was the result of a long chain of human mistakes. Mistakes not of one person or even one institution, but of systematic problems in the structure of the modern financial system. It was the result of greed. And yes, greed. People wanted more money, bankers wanted more commissions, investors wanted more profit. All of this, combined with insufficient understanding of risks, combined with a lack of adequate supervision, combined with incorrect probability models, combined with psychological panic, and with the globalization of finance, all of this led to one of the world's largest economies ending up on the brink of collapse. Government intervention on a scale never before seen was needed. Coordinated international action was needed to prevent complete collapse. People who lost their money often did not understand why it happened. They lived ordinary lives, were craftspeople, nurses, teachers. They made reasonable decisions based on the information they had. They trusted banks, trusted regulators, trusted experts. And they all turned out to be wrong. This lesson was very expensive.